We've seen in an earlier module the importance and relevance of a credit report in the decisioning process, in the process of writing your credit policy, and how it integrates into the decisioning making of the company. The second component or the second layer of this decisioning process is the credit score. So the credit score and the credit report together form two important pillars which all lenders use to help them take a decision, along with other factors: the bank statement, the balance sheet, the P&L, the salary slips, etc. In India and many parts of the world, the score ranges, as I said, between 300 to 900. 300 being the lowest and the most risky, and 900 being the highest and therefore the safest indicator. In India, over time, a good practice has come that 750 is a good score. If people have 750 as a score, you could in all probability say they will get a loan. Or if it was lower, then the probability of getting a loan starts diminishing. Now, where did 750 come from? It came from practices that the lending institutions evolved, and they themselves saw over time that people who had 750 or more did not default on their loan, were not late in their payments. Whereas if they were below 750, then the likelihood that they would not pay was proved so by looking at the portfolio and the behavior of the portfolio that had been already sanctioned. So the credit score, which is used by all lenders in India today, along with the credit report, are the two pillars of taking a credit decision. Quite honestly, and this is my personal belief, and I think global practices have shown that it's not a yes-no because it's 750 more or 750 less. There is a concept in economics and everywhere else of a risk versus reward. So if you're taking a risk by giving a loan to somebody with a lower score, your reward has to be higher. And that brings me to a topic which is increasingly becoming popular in India now, which is differential pricing. If you have a score of X, you get a loan at a particular rate of interest. If your score is lower, then you will get a loan, but the rate of interest might be higher because the risk is higher. And that is the true value of a credit score, where you differentiate risk based upon the likelihood of the person paying or not paying on time, which is reflected in the score, and then decide on the price that you're going to charge the person. Now, broadly, there are two kinds of scores we have to remember. There are a couple more, but let me highlight the two that matter. The first is the application score. When a person applies for a loan, you score him or her against the bureau's database and you get a score. You get a number. Based on that, you use it as a tool to decide give, not give, how much to give, on what terms to give. Now, if after having given the loan, you can do what is called a behavioral score, where you can then look at the likelihood of the person's behavior based upon his repayment history with you, and therefore come up with a score to see whether his score is improving from the time you sanctioned it or has it deteriorated. That can give you 2 or 3 hints. One, if the score has come down, you might want to be more careful in terms of the recovery process, and you want to start the recovery process a little more proactively. Call him up, talk to him, make sure he's putting the money into the bank account to pay the monthly EMI. Alternatively, if the score has improved, you might want to reward him by maybe dropping his interest rates by a few basis points. Because just as you find risk as a component of deciding the interest rate, similarly he looks at comfort to kind of try and negotiate a better rate. And if the person is paying on time, you obviously want to retain him. And an obvious way of retaining him is to take the score, see the improvement, and give him a price differential by charging him maybe lower than what you started him off when you sanctioned the loan. Now, there are other scores. In India, we don't have them as yet, but there are other scores. So, for example, you will have something called a retention score. A bureau can actually tell you that if you change rates, will this customer stay with you or will he exit and transfer to another lending institution? Now, you might look at all this and say, how does this actually happen? How do I know that Mr. A is going to stay with me or balance transfer out if I change the rate? And the more fine-tuned question is, at what rate will he actually move out? What is his tolerance level? Now this, along with all the other payment behavior of the person, is the algorithm that the bureaus build in their black box, which develops the score. So the bureaus will look at a host of parameters, and they will look at a combination and a permutation combination of all these parameters, and they will develop a score based on the behavior of their own data. So for example, if I am buying a car and I think that the Mercedes is a safe car because I think it's accident prone, I will give it a high score on safety. Now that is my judgment. What matters is statistically what is the fact. How many Mercedes accidents have resulted in deaths? How many Mercedes accidents did not impact the life of the person driving or the passengers? That data is a true reflection, and that has been statistically calculated as against, I think the Mercedes is safe because it's a German car, for example. Because that is judgment. But the reality is that the statistics that talks, the statistics of continuing data, all these components, income, age, education, past payment record, mix of credit, secured loan versus unsecured loan, and so on and so forth. Now it's not just these 7, it's a combination of all these 7 run over multiple algorithms tested on the database to see that if a score gets thrown up at 750, does it actually reflect the customer's payment history, that he is paying well? Or if he gets a score of 600, is the customer having some delays in his payment? Has he been delinquent in the past? Are his checks bouncing? The validation of that score along with your database is what makes the score a more robust and a more valid number. Now, by the very nature of this score, it keeps changing. As more data comes in, as payment history comes in, as new borrowers come in, as old borrowers exit your database, the behavior of your entire portfolio will change. And when that behavior changes, the consequence on the score will also change. Suffice to say, you as a lender, as a front office person, should look at the numbers of the score that are thrown up by the bureau and compare it with the credit policy that your credit people have written and apply that in terms of yes, no, if so, go, no go. If you are writing the credit policy, then there is a larger effort on your side. And the first effort there is that you need to see whether is 750 good for your company or is 700 good for your company or is 775 better. Now it's not a judgment call. It also depends upon the way your portfolio has behaved. Have your 750s in the past behaved well? Do you want to try 700? Now if you find that when you drop the tolerance from 750 to 700, that people are suddenly being seen to be delinquent, you don't want to change your credit policy. You want to leave it at 750. But if you find 750 itself causing high delinquencies, unacceptable delays and defaults, then you might want to start playing with that threshold and taking it up to 775 or 800. Again, it's a trial and error to that extent that you take it up and see the impact on your portfolio. If it is good, then you stop there. If it's not, then you need to raise the number again. So these are the roles that a credit score plays along with a credit report in your lending decision. Again, the score by itself, like the report, is meaningless. How it works with your credit policy is what is important. Now there is one other angle I want to talk about before we move to the later part of this particular module, which is that large companies with large databases can also develop an internal credit score. That internal credit score is based on similar parameters that the bureau score is. However, it is focused on the behavior of that company's portfolio. So for example, if that is a microfinance company, then the database of that company will obviously be full of microfinance borrowers. And then the behavioral pattern of microfinance borrowers will be significantly differently focused as compared to a larger database of the bureaus which have data from microfinance, high net worth, credit cards, mortgage loans, car loans. So the large numbers in the credit bureau which help in giving a larger and a better score are offset because they are general compared to your institution which is doing only microfinance loans, for example, and therefore you develop an internal score. Now, from a credit policy perspective, you look at both the scores and see whether there is a significant contradiction. Is one score high and the other low? In which case you need to take a credit decision what to do. If both are high or both are low together, that means there is some correlation between the two scores. The score based on your specific focus database and the bureau's larger database but a more general database. So here's a visual representation of a judgmental score compared with a statistical score.